This is the Investor Connect podcast with Hall Martin for 2017. In this episode, we discuss the family investor office environments today. In this episode, Hall Martin of the InvestorConnect.org series conducts an interview about the concept and best practices for the trend of family investor offices. Now, this podcast series was initially called Angel Connect at angelconnect.info. Well, now it's Investor Connect at InvestorConnect.org, and it continues with the same series of professional interviews conducted by Hall Martin. In this interview, Hall and his experienced guests describe the roles of family investor offices versus the institutional side of investing, including the present approach versus the past strategies. If you're not aware of this term, Google describes the family investor office as, quote, private wealth management advisory firms that serve ultra-high net worth investors. They're different from traditional wealth management shops in that they offer a total outsourced solution to managing the financial and the investment side of an affluent individual or a family, unquote. So this interview discusses the pros and the cons with the single-family office environments and even the multifamily office world, and specifically, the topics range in types of deals, diversification, asset allocation, capital commitments, and so forth. And they give a perspective of diversification versus the specialized expertise, as well as considerations for active participation. Most interestingly, it includes the discussion of hybrid approaches. I think you'll find that very, very informative. And they suggest guidelines for the best practices, including how to plan a strategy with the partner mentality. In addition, the question for the future is raised. The question would be, what can be the effect and role of data analytics in the decision process for selecting winners in the family investor office environment? An informal listing of resources is given at the very end for family offices. Now, the contact information for email is given at the end of the interview in the audio. And if you need more information, you want to contact the new website, go to www.investorconnect.org. If you want to speak to Hall Martin, it's www.investorconnect.org/contact. Now, Investor Connect is a program under the Texas Open Angel Network, which is a 501c3 nonprofit dedicated to the education around startup funding, and Hall Martin is the principal contact. Again, his website is www.investorconnect.org/contact. Now, let's listen in to this particular interview in which Hall Martin brings up the topic of the trend of family investor offices. And he gives the best practices. So let's listen in.
All right. Well, Rohit, thank you for taking time to talk today. You're the general partner at the Casas Capital. Can you tell us a little bit more about what that group is all about?
Sure. So here at Duchess Wealth Capital, we manage and invest the capital of the Duchess Wealth family. So we're a single LP family office. Our holdings, are really split between an operating entity. Previously, we had more companies that the family owned outright, but now that portfolio is down to one, a company in Chicago called Chamberlain. And then there's the investment side at Duchess Wealth. Each side is around $1 billion in assets. On the investment side, it's been a mix of different things that we do. We continue to do mid-market private equity deals, fund-to-fund investing as a limited partner, and some direct investing and really these days growth stage of venture and technology companies. Over the time, there's also been a basket of real estate investments and some public positions that the family has amassed as well.
Well, you've been there for quite some time, 12 years or more, I believe, and so you've probably seen the evolution of family office investing shift from one phase to the next. Can you talk a little bit about where it's been and where it is today?
No, sure. It has been an interesting ride, and I think, one aspect of the family office world that hasn't changed is, they can definitely take a long-term perspective to what they do. They can ride through business cycles in very different ways than folks on the institutional side have to respond to, what's happening in the world around us. definitely experienced that through the recession, and we had the ability to double down and be patient through it. But even with all that's happened the past decade, I think the approach that families are taking now is just being more direct stewards of their capital. I think they used to be more reliant on fund relationships or wealth asset type of manager partners to deploy their capital, where they're paying their 2 and 20 or whatever that might be. And I think these days, particularly as there's been a younger generation of folks that have amassed wealth and come into the game, through what's happened in the technology world and biotech and others, there's just a different kind of more hands-on approach. So I think family offices, there is a rising tide in being just more of a direct deployer of capital and having, less of it, driven through sort of passively allocated funds, even on the private asset class side. And, each family kind of comes into this in different ways and has different gaps that they're trying to address. But I think, whether it's just being more in control of what's happening with their capital, as well as wanting to just be smarter on fees that they pay across their portfolio, being more directly involved with investment strategies seems to be sort of a rising tide these days in the family world.
Well, I see a lot of family offices making this move or transition, and some seem to go it alone with a single-family office, and others seem to join up with others into a multi-family office. What are the pros and cons between the single-family and the multi-family?
That's a great question. I have a ton of perspective I can share on the single-family office world. A lot of my perspective on the multifamily office world is anecdotal in that, we typically haven't done that themselves. What I've seen really is, it depends how many assets you have and how diversified, you do or don't want to be. So for single family office, and it also depends on the type of deals that you want to do. So, if you take kind of what anyone would have, kind of their wealth, their pie chart, and kind of think about asset allocation, that starts to drive, how much is available on a gross basis in a different asset class. And then you should think about, from a diversification standpoint, how many investments you need to feel good about that kind of a portfolio. And, if you can make it work on your own and can surround yourself with experts and expertise, single family can work great. I think you typically tend to see, an asset base of at least, a couple $100 million as a family, for that to make sense. And, as you build up more of a staff behind it, it probably is, in the north of $500 billion plus, where you can have kind of a staff of a handful of folks going off to do these things. So clearly, you've got more control, you can set your direction, and, you can really choose how aggressive and what you want to do. You're just accountable to yourself. In the multifamily office world, I think you're trying to create scale, by combining wealth of or asset base across, a handful of families. Perhaps there is domain expertise that's complementary and leverageable across each. But it does require sort of more of a commitment. I mean, if you're going to enter into a partnership with other groups, you're quasi sort of institutionalizing yourself, and which is good, but also forces you to sort of stick with something through, and offers less flexibility. So it's all on how these things are structured and how committed the capital can be. But, as I said, most of my experience has been on the single family side and a little bit less so on the multi side.
Do you see family offices becoming very specific in their area of expertise and only doing those deals? Or do you see them trying to diversify across many different types of investments in order to get the benefits of diversification? Although now you have to be an expert in all those other areas. What's the trade-off between those two?
Clearly, family, we experience this ourselves, some of the areas in which we owned businesses, we knew sort of all the deals in and out. And the people, the relationships had unique value. And clearly, as families start to do this and start to become more direct stewards, they should definitely stay in that swim lane for sure. The question is, what does that swim lane look like? How deep does it how deep is it? How does it represent enough of a profile of opportunities to sort of suit, other aspects of the portfolio that you're moving away from passive to more of an active strategy. And typically that involves, some aspect of diversifying, which by definition is areas in which you are not an expert. So that exactly is the challenge, as this rising tide of direct investing. I think it is taking families in areas in which, they are less experienced. I think many are aware, and they look to augment themselves, with that expertise through the networks they try and build, and whatnot. But the question always is, why am I seeing this deal? Is this a good deal or not a good deal, and why is it here first? If a group can kind of vet and identify and diligence, through creating kind of their network of domain experts, hopefully that starts to give some comfort around it. But one avenue as well is kind of doing these hybrid kind of limited partner relationship with funds. Co-investment opportunities with funds has become more of a rising tide and almost a product by which, families can begin to get more directly involved in investing, build kind of credibility in areas that are new to them, but leveraging kind of the relationships and deal flow that a general partner has in the space. And, these funds are setting themselves up to kind of serve family offices in that kind of a partnership and spend their time, but also economically, where, they'll put some of the money from the deal comes from the fund and the other comes directly from LPs as a co-invest. And, the carry and the management fee typically paid on that is less than what you do when, as an LP, you commit to the GP. So, that's turning out to be a nice way to kind of do, crawl, walk, run as a family office tries to do more direct investing in areas in which, are new and different to them.
Well, what percent of their funds are in the fund versus in a direct investment when they use that hybrid approach?
Good question. As a percentage basis, let me think here. You can lever that relationship fairly well. You could see anywhere from, at least 1x to say half an x, 1x of your LP commitment to a couple x that in co-investment, depending on the deal and the transactions. I know we had one example in our portfolio where we made an investment in a fund. We'd backed this fund for a couple times, so it had been over a couple of fund cycles that we've known them, and we brought them a deal. It was more of a mid-market, private equity deal, but we split that deal sort of 50-50 on it, and I think that investment from our side was sort of 2x what we put in the fund. So I think opportunities can present themselves, to kind of really deploy, your direct capital in a leveraged way. And but it all depends on the appetite that you have.
So the initial investment maybe is through the fund, and then maybe follow-on investments are direct because now it's a known entity and the basic due diligence is done. It's just updating what they have. Is that how it works, or is it the other way around?
I think there are many ways to skin the cat. The example I described was really more of a private equity deal. So you're doing a controlled transaction, and the follow-on capital is minimal. So kind of it's all up front. I have seen some funds come in and structure kind of co-investment where they're raising, a small venture fund or seed fund, and they won't have the capital to do all the follow-ons. They'll have a pro rata right in some exciting growth stage companies. And so I've seen them structure those pro rata allocations as co-investment opportunities for family offices. So it's really thinking through, I think, the Venn diagram of how much you want to deploy, of what stage you want exposure to, and how much kind of help or expertise you need to kind of see the best deals or quality deal flow.
I see. So I see a lot of family offices starting to do direct investment, but I'm not sure. Well, what are best practices for setting up for managing the deal flow. In startup investing, you have to find the deal, you have to qualify the deal, negotiate the terms, and then maybe it goes forward from there. What are the best practices for setting up to do that properly?
I think there are a couple guidelines I'd give. One is, either know the domain or start to develop, start to have a relationship with people you trust around the domain. And I think, the capital scale and flexibility of financing that family offices typically have, should attract the right kind of relationships and people to want to spend time and build that out with you. Second is, I would say, take more of a partner mentality. Not just through, I'm not just talking about these co-investments as a limited, but even in terms of doing deals side by side in a syndicate with other venture groups or growth equity or private equity firms. I think it's worth it to kind of share a good deal and let other people in, begin to demonstrate value that others see, that you bring to the table. Typically, families have got an operating culture and heritage and just ways of kind of doing business, that is a best practice in of that. I think that kind of governance is usually appreciated by the business as well as, the other investors. So, err on the side of syndicating out rather than trying to do everything on your own and add value, right? I mean, that's how you kind of get brought in through to the next deal through kind of the world of venture and other growth investors is, they see you add value and you're useful in certain cases, and then they'll want you in on another deal to round it around or do something like that. It takes time to kind of build all that up, but if you set the objectives and start to organize yourselves around the metrics towards achieving them, I think that starts to improve the quality of your deal flow.
Well, aside from investing funds, what are the other ways most family offices can add value in these deals?
So besides, typically their capital is flexible. They're willing to look at, debt deals or whatnot. I think they can have networks and connections that are quite different and juiced up than the institutional investors. The billionaire club is a small club. So the usual way of adding value through introductions and relationships and things like that. I think they can be a unique sounding board to the management team. I mean, typically, if you've made that much money, you've operated or started or grown a business or multiple businesses to successes. So there's a lot sort of learned and sort of a mentorship that can come out of that as well. I think you just have to play the angles that everyone plays in adding value, kind of the relationships, the advice you can give, how you provide the capital that you can. And, really try and leverage where you have a unique access or background or skills to go off and do those things.
So as family offices start to invest more directly, where do you think VC funds end up going in the future? I see some moving into more pledge fund models where they simply get paid for finding a deal that gets done and maybe doing more upfront deal flow and due diligence, but not actually managing the portfolio in some cases. But where do you think the VC funds will end up at the end of the day, or what direction do you see they're going in?
That's a good question. I mean, I guess it depends what kind of fund you're talking about. If you're talking about, a fund that's sort of an established platform and sort of, fund 4, 5, 6, we've seen even funds like that not be able to continue their longevity, but provided you can identify and kind of be in front of, the next wave of disruption as it's coming, I think, at that point you cemented yourself in the marketplace, and there's, still a lot of institutional capital, from endowments and pensions and whatnot that is passive, for the most part, but they want to bet on proven platforms. So, if you're at that and you can maintain kind of, being that kind of a performer, I think you're probably okay. If you're kind of an earlier fund trying to get off the ground, funds 1, 2, or 3, I think that, there's going to be sort of more competition through kind of family offices doing more direct investing. I think the model it's still going to take some time for those family offices to be as experienced and be as kind of sharp as a deal doer as kind of folks in an existing institutional firm. So there's a lot of time kind of for a partnership to exist, kind of this co-investment angle that I talked about. I mean, you're right. The most kind of bare bones version of that co-investment is a pledge fund where, it's all sort of on a deal by deal basis. But if somebody's seeing quality deal flow and families want kind of first access or, want to get first pick at it, I think that starts to create, some leverage to form kind of more of a captive fund and have family offices commit to at least some size of a core pool to invest. I think as usual, kind of the strong performers that, are able to attract deal flow either from their, brand and track record and longevity or, their, individual position in kind of the flow of attractive and disruptive things, they'll be able to kind of command and pull together. The flip side of it is, many family offices will be looking to invest in partner than have before, so not just the endowments are the source of your capital source to form an institutional fund. If you're creative about how you go about it, these family offices, can help seed funds and get them off the ground. But, if you don't have a culture of collaboration from the outset, it'll be hard to kind of pitch that and then go off and make it work.
I once read that VCs basically do two things. They find the deals and then they provide management expertise. Fundamentally, everything they do falls into one of those two buckets. And with the rise of data analytics, some are predicting that that part of the VC job goes away because data analytics will be helping find the deals, match them to the right source of capital, and so they're left basically the VC with doing providing management expertise, helping build out the team, coach through the process of growth and scale, and et cetera. What's your reaction to that?
I don't completely buy the first part. I think, so much of making an investment decision is trying to ascertain, what's going to happen in the world, 3, 4, 5, 7 years down the road from, making this investment now. And I think data analytics are going to give us more information and hopefully make it easier for us to kind of form an opinion and a thesis, but kind of, weighing the risk to reward of that and what's the right deal to add or not add to my portfolio. I don't see how you automate that. I think it's still, at the end of the day, these are subjective decisions that we're trying to make as objective as possible, and data analytics can help in that. But it's hard for me to see kind of the bot kind of deal sourcing and I mean, to that end, these VCs are going on the boards. You're building a relationships with the CEOs and the management team that you have. So without that really clicking and without that, going through its own relationship building process on the front end, I don't see how you can automate that. You can maybe kind of find out about companies and this and that in a smarter way, but, that just feeds the very, very top of the pipeline.
Well, it's always such a risky business. Even the best data doesn't always predict where the winners are out there. And as an investor myself, It's often surprising to see where the winners come from and where what I thought were the winners, where they end up for whatever reason. Sure. People couldn't get along. Markets change. There's lots of dynamics to it that make it pretty tough to do. And you made an interesting comment the other day that unless you're ready to go and invest in enough deals to get diversification, it can be tough to win at the startup game investing. What's your take on diversification? How many deals should someone do before they really have a solid position in this?
I think it really depends by asset class you're talking about. If you're talking about kind of early stage venture, you should at least have your 20 deals and not just 20 deals. You've got to look at the time period. So pick it whether you're on the Olympic year cycle or the election year cycle or whatever 4-year phase you want to be on. But, pick your 20-ish deals, to diversify through that. For seed, multiply that by 2. For mid-stage growth equity, you can probably divide that by 2 down to 10. Unless you're diversifying through a time period, you tend to be chasing and, you will tend to sell quickly. because you'll think things will have run up and you'll try to time the market, and then you'll be hesitant to invest when kind of markets drop, and because you'll think they're going to drop more. So it's the same market timing dynamics that your asset manager talks to you about the stock market. I think it applies here as well, which is the whole reason why a lot of funds, a lot of the benchmarking happens by the index year in which they start to deploy capital, just trying to normalize for the business cycles.
That's a good point. Any other thoughts about best practices for actually running a family office in this area?
I think this is an important one. It's kind of how you build an organization with people and whatnot. Everyone has their own style and priorities behind it, and I see family offices sort of go between trust versus experience. People that have been with the family doing different things versus people that have kind of professional investment experience. If you're really going to start to be more direct in how you deploy capital, I'd say, prioritize experience, investment experience, assuming there's kind of fit with your culture and value system and whatnot, and sort of build a relationship, kind of a incent kind of a working relationship. So I said loyalty is built. I think that risk is better taken than the risk of somebody who hasn't done much investing all of a sudden, being able to figure out the direct investing side of it. And, even though they might have had that trust and been with the family for quite some time, it takes time to become sort of an experienced, smart investor. And you're better leveraging what people have learned in other places, institutions, if you're going to try and, act like an institution yourself as a direct investor.
So where does one go to learn more about this? What resources have you found out there to be helpful to family offices like this?
Typically there are a handful of sort of groups. There's the Family Office Network, FON, F-O-N, where families can join and start to learn more and get connected really with other families. There's not kind of the NVCA like for family offices. I'd anticipate over the next 5 years they probably form a subgroup or something like that to represent kind of more capital like this that's in the space. And the saying is, once you've learned about one family office, you've done exactly that. You've learned about just one family office, and because everyone does things their own way. But the good thing is, there tends to be a really tight, friendly, collaborative community. So, folks are more than happy to kind of share. So, it's kind of old school network. And there are a couple of forums, the Family Office Network. There's one here in Central Texas as well. So you can find those groups, fairly quickly. And folks tend to be fairly collaborative and open about what they've learned and how they're doing things.
Well, thank you for sharing your information. I get a lot of family offices coming to me wanting to move from funds out direct on their own. They want transparency. They want control. They don't want to pay all the fees that usually come with it. And so there's lots of reasons people are moving in that direction. And it sounds like pretty good information. Was there anything else you wanted to share with people about this?
No. I think you covered kind of more than I thought I had on the topic. So I very much appreciate, your insightful questions, and was glad to be a part of this. And, if anyone, wants to learn more, talk more, glad to share kind of what we do here at Duchess Watt. So, just feel free to let them know that I'm open and willing to talk.
What's the best way for people to reach you? Is it through LinkedIn, or what link should we put up there?
You can put my email address here at Duchess Watt, the RSETH at Dutch.com.
Well, great. Thank you so much for taking time.
Sure. Thanks, Paul.
Thanks. Talk to you soon.